Hi, everybody. Welcome to Couples Create Cash Flow, where we talk about how to get financially independent as fast as possible. Today, we're talking about HELOCs and velocity banking. So, the question that we're asking ourselves, and it's a fair question, why would we want to get a HELOC if we want to be debt free? Why would we want to borrow more money? I thought I was trying to pay all this money off. Why do I want to borrow more? Let's get into it. So, first of all, I would just like to say that I would love to help you start velocity banking. Maybe at the end of this video, you feel like this might be interesting. I want to give it a shot. It is complicated, but I'll try to make it as simple as possible. First of all, I've got a free guide that helps you kind of know the steps of velocity banking. And it also has a HELOC checklist, so you know how to compare offers at different banks and credit unions. I've also just finished recording videos, and I'm about to launch a new course called How to Get the Right HELOC for Velocity Banking. And that will be launching on March 15th, so just a couple days away. And so if you want to check that out, there'll be a link in the description below. And then finally, I do have an option for individual coaching, and I'd be happy to meet with you for a free 30-minute discovery call to see, kind of where you're at with your finances and if I could help you. So let's get into the topic. First of all, what is a HELOC? If I'm speaking a different language to you, a HELOC is an at-home equity line of credit. It basically will take the value of your home, and up to 90% of that value then could be lent out. If you add up the mortgage plus a HELOC, it can't exceed 90%. So if you were looking at the amount of HELOC you could have on your house, you would take your estimated home value, you would multiply that by 0.9. That would be your 90% loan to value. And then you would subtract the balance on your mortgage from that 90%. And that would be the maximum HELOC that you could get. HELOCs are kind of a different animal than what you might be used to when it comes to financial tools. They do have a floating interest rate. It is not a fixed one, unlike your mortgage, and it will float with the prime rate. Some HELOCs are structured different than others, and so you do have to look when you're searching to see if your rate has a base rate that will kind of be the minimum it could ever possibly get, regardless of what prime is doing, or if it's something that kind of floats up and down with prime and does not have kind of a minimum amount. I've seen some where their minimum amount is 8.5% or something like that, and then can go up from there. But for others, I've seen go down to 4% or even 3.75% because that's where prime ended up going. So it's good to know how your interest rate will float. And also, because of the way that this tool works, interest is based on your daily balance. So what happens is they take your annual interest rate, divide it into 365 small little portions, and they charge you that amount for each day's balance. And then at the end of the month, they add all those dollars up, and that's how much you owe them on an interest-only loan or line of credit. Sorry, you're going to catch me saying loan sometimes when I mean line of credit, but that's plot. But it's also because that's how the bank looks at it. They consider it a loan. You don't get charged interest unless you take money out of your line of credit. So you will only have to pay interest for whatever balance you currently have on that day. And that also means that with velocity banking, your goal is to try to get monthly payments that you have to pay each month to be eliminated by paying them off through a HELOC, because you take the amount you would have paid in the monthly payments and you turn it into an interest-only payment, which means you can apply more money towards the principal. And the fact that your interest is only calculated based on your daily balance, your balance should be going down each time you make more money, which does allow you to have less of a principal to even have the interest rates charged to. All right. So the question is, isn't a HELOC just like a big credit card? Well, there are some things that are like a credit card when you think about a HELOC. First of all, some similarities. They are both lines of credit. They do have a credit limit. They also have a low monthly payment for the balance amount. So if you think about a credit card, their minimum payment is not really what you would expect to pay if you amortized that that amount. Like if you had $100,000 on a credit card versus a $100,000 mortgage payment. The mortgage payment is going to be set up so that you have incremental payment, or sorry, the payments are going to be the same every month, and it's going to spread out over the course of that loan. Whereas the credit card might take the total balance and then multiply that by 1.5% or 2% or something like that. And then that's how they determine what your minimum payment is. They're not too interested in you paying it off faster because they can charge you quite a bit of interest, right? So the low monthly payment is the same, especially if you have a HELOC that is only going to have interest-only payments. Also, your interest that you're charged is that annual rate divided by 365 times your daily balance. That is the same way that a credit card will charge you, and then you'll pay that off in your statement once a month. So same thing, both ways. They're both revolving in nature. So when you pay down your balance, you also now have more access to your line. So if you had a line of $20,000 and you had a balance of $10,000, your spending limit is $10,000. But if you decided to pay off the $10,000, well, now you have $20,000 back at your disposal. So it does create kind of an interesting scenario when you think about tapping into the equity of your home. So when you have a credit card, you're tapping into your ability to make payments. There's not really equity there. But when you're tapping into your home equity, this is something that you've been establishing for a while as you've been making your payments. And so there is actual real money there. We'll get to that in a minute. Fluctuating interest rates are also part of the deal. So if you have a credit card, their interest rates are going to float as well. It's just going to be a lot higher than a HELOC. For example, I believe my HELOC right now is at about 8%, but the credit card that I have is at 25 or something like that. So it's much, much higher to have the interest rate of a credit card. Here are some differences. HELOCs are tied to your home, which means they're secured. A credit card is tied to your income, which is unsecured. So basically, if you stop making payments on your credit card, they don't have an asset to take in order to pay off their balance. So then they send you to collections and they ruin your credit score, which makes it harder for you to get money in the future from a bank or a lender. Whereas a HELOC, they will only loan up to a certain value of your home. And so typically there is not anything that you would be charging to your HELOC credit line that would exceed the value of your home. You are not able to spend money you don't actually have within your net worth. So it'd be the difference between having $20,000 of equity in your home when you run a net worth analysis. So let's say you have a house that's worth $300,000, and then you have a loan balance of $200,000. That would show $100,000 in equity, right? If you had a HELOC for $20,000, then you'd be tapping into that $100,000 of equity, and you'd be able to use those $20,000 within that equity that you've already earned or created, or maybe the market has changed and your house is worth more. But on the flip side, if you looked at your balance sheet or your net worth statement and you say, okay, well, I have a credit card with a limit of $20,000, no balance on it, that doesn't show up in your net worth because it's not real money. It is the ability to spend money that you've never earned. They're basically trusting the fact that you'll pay it off. And so HELOCs do play into your net worth and they tap into dollars that you've already created. HELOCs have interest rates. So this is a difference. They have interest rates that are typically around a quarter of the rate that the credit cards charge, so a lot lower. And that is because they're secured by your home. The banks have less worry about you paying it back. They know that with a HELOC, if you were to foreclose on your home, they would have access to some of that foreclosure money. So the house is more secured, or the loan is more secured because of that. The interest rates go down. All right, and then for HELOCs, like I've mentioned before, you do have an interest-only payment versus the minimum payment on a credit card. Now, some HELOCs are set up with minimum payments. So even if you don't have a balance, they may say you got to pay $100 a month for some reason. That'd be kind of silly. So when you go to actually set up your HELOC and get the right one for Velocity Banking, you want to make sure that it's interest only. That allows you the most flexibility when it comes to making repayments. Now, if you are doing true velocity banking and your paychecks are going directly into your HELOC, those count as payments. So it really doesn't matter if there's a $100 payment or not, right? It just matters that you are depositing your paychecks. And then on the bottom of this one, it says HELOCs operate like a checking account, whereas a credit card cannot be used for certain fixed expenses just like a mortgage or rent. So yes, I can take money from my HELOC and pay my mortgage. Whoa. So the equity in my house is actually making my mortgage payment. Now, if I were never to put my paychecks in, that would not make much sense. Why would I create more debt for myself while paying off a debt? That makes zero sense. But because I'm putting my paychecks into the HELOC and making that my checking account, then it does make sense, because if I was going to pay my rent or my mortgage, I would write a check or I'd have it direct deposited. And so as a velocity banker myself, I have my HELOC and it functions like my checking account. I run all my expenses, my rent or my mortgage through there, direct deposit that money to my lender, piece of cake. I don't have to think about it. Whereas if I was trying to run all my expenses, and obviously there are some expenses that I do run off of a credit card, mostly because of the benefit for the rewards, the cashback or rewards programs that come with that. I wouldn't be able to pay my mortgage with my credit card. So it is definitely a benefit that the HELOC is that flexible. So why would I want to go into debt? So one of the main things that we talk about with velocity banking is that it can help you become debt free. And it may seem like it's crazy to take out a debt on your property in order to pay off other loans, such as a car loan or something like that. So why would you want to do that? Doesn't that seem like you're taking a step backwards? Well, with a HELOC, you're not actually borrowing any money. You're getting access to your equity. So your interest is only charged when you use it, not on what your limit is. So you can open up a HELOC for almost no fee, especially if you can find a way to get a value on your house that is not tied to an actual appraiser coming out to look at it. So if you get an online appraisal, you can get an application through for a HELOC sometimes with zero fees. Sometimes it's $100 or $200, but very, very cheap to have access to the equity in your home. And then since your home is securing the HELOC, it's not technically possible to go into debt unless the value of your home goes down by a considerable amount and your HELOC is maxed out. This equity is actually a real asset to you. You just don't have any access to it right now if you don't have a HELOC. So as you pay down your house, so here's my story. I was really a truther when it came to paying off my house. I was looking for the fastest and best way to pay my house off. And that's what actually brought me to velocity banking. I learned about how you could pay off your house in 5 to 7 years. And so I was like, wow, this is exactly what I want. Because I got to the point in my life where I actually didn't have any debts besides my house. So I was like, I got to take care of this house. I want to be debt free. And so what I learned was if I take out a HELOC, I could start making chunk payments towards my mortgage with my HELOC. And as my paychecks paid back the balance on the HELOC, I could make another chunk payment. And what you see with home mortgages is the quicker or the sooner you can make large payments on a big balance like that, the faster you pay it off and the less interest you pay. So if you ever looked at a bank, like a mortgage calculator where you can make extra payments, and you try throwing a $20,000 payment in and see how many months that shaves off of a 30-year loan, it's astronomical how quickly that can help you. Because really in the first 10 to 18 years of your 30-year mortgage, you are not really paying that much towards your principal, especially the first 5 to 7 years. A lot of it's just going to interest payments. And so you don't make a lot of progress on the principal of your loan until you get into those later years. And so what you're doing by making a big chunk payment with the velocity banking strategy is you're speeding up that window of time. You're getting from that early parts where you're hardly paying anything towards your principal, like 5% of your payment goes to principal. You're basically catching up to where other people would be if you had a 15-year loan or something like that, where you're paying a ton more towards principal right away. Now, obviously, you're then transferring the debt over to the HELOC, which then does have its own interest rate. But because you're using the cash flow from living a life where you make more than you spend, and you're freeing up money by earning more income and reducing what you spend, you actually have an instant reduction of your loan when you're doing velocity banking every time your paycheck goes in. Now that does not happen if you have your money sitting in a checking account. If your payments get going directly to your checking account, then you're paying your bills separately. You're not earning any money on that checking account, and yet the interest is being charged to the balance on your loans or your mortgage every single day, basically, or your credit card every single day, right? And so, if we look at this from that perspective, you are having a much quicker impact on your debt and your interest because everything that you own or the buying power that you have starts to get shifted to the HELOC, and your expenses run through the HELOC so that everything's in one place. It's a lot simpler. Now, you have to really think differently about it because if you're used to carrying a certain amount of money in your checking account so that you can have a buffer, like make sure that not, $10,000 where, something happens, that your checks won't bounce or something like that. Well, if you're carrying a buffer of $10,000 in your checking account, it's doing nothing for you. It's absolutely lazy. It's not helping your debt go down. It doesn't help your interest. It doesn't earn you any money. It's just sitting there for your peace of mind. But if you were to apply that to a loan and then have a HELOC with a spending limit that goes up to $30,000 or something, well, then you don't need a buffer of $10,000 because you have the spending power then to cover anything that comes up. So I've actually used my HELOC as my emergency fund and poured all my emergency fund money into debt repayment. So when we talk about you can't really go into debt, I want to be clear about this. Debt is when you have a negative financial position or negative equity. So HELOCs are not given to people with a negative equity position on their house. They will not give you a HELOC if you don't have equity, right? So if your house is worth $300,000 and you have a mortgage for $280,000, there's no room, there's no equity there. They're not going to give you a HELOC for $20,000 and bump right up to it. Now, I will say there may be 100% HELOCs out there. I would not do them. They are much more likely to be called by the bank if the housing market takes a turn downwards. So really think about that, whether or not a company will give you 100% loan to value. You might not want to access more than 85 to 90% of your loan to value. Anyways, that's a side topic. But as of today, I would just tell you, I look at debt as I have a negative equity position on this particular thing. So a great example of this would be a car. So you could buy a car at the dealer for $20,000. As soon as you drive it off the lot, it's worth 15, but your loan is still 20. And so as you're paying it off over 5 or 6 years, your balance is probably going to be higher than the value of your car. I've seen that happen quite a bit. And so unless you pay it down faster than they say to, you can sometimes continue in a negative equity position where your car is actually worth less than the loan that you have on it. I would call that being in debt. Now, if you had a car that was worth $10,000 and you had a loan on it for $500, well, then you probably are not in debt. You're just still making a payment on that loan. A home is very similar. A home has a value to it it is actually very easy to calculate. You just bring an appraiser out and they tell you what the value is. So it's a durable asset. It does have intrinsic value because people need a place to live. And it does fluctuate as the market fluctuates. It goes up with inflation. There's a lot of security to that. And the fact that you make monthly payments on a mortgage means that you have established good credit, typically. And then you get to the point where you've been paying down your principal. You don't have access to that money until you pay or until you sell the house. Well, most people don't want to sell their house just to get, that equity out. So this is a great way to tap into the funds that you have saved by making mortgage payments without actually being in a negative equity position on your house. You still will have a positive equity even if you have a HELOC that goes up to the 90% valuation. They bake in a 10% cushion, right? Now, credit cards by nature are a negative equity tool from the beginning because nothing collateralizes your credit limit except your income. So, like I said before, it doesn't show up in your balance sheet, right? If you do a net worth analysis, a credit limit doesn't show up, right? It is only your loan against the credit. So if you decided to go out and use $10,000 on a credit card, it will never show up as an asset. It will always show up as a liability. And so when you're doing velocity banking, you are not creating the opportunity to spend money you don't have. You are literally just tapping into the equity that you already have in your home. So the goal of getting a HELOC is to free up monthly cash flow by paying off your debts completely, which then enables you to pay back the balance on your HELOC faster. When you paid off all your loans that cause monthly payments, then you can start to focus on how to use your HELOC to create more cash flow through income producing assets like real estate and business. So I see it as kind of the first phase of velocity banking is to get rid of any kind of loans that don't make sense, that are car loans, student loans, credit cards, store credit cards, any kinds of accounts that are based on consumer-based products or on assets that are going to go down in value pretty quickly. Those types of things, they're not good to have any financing for. On the flip side, if you got a home loan right now that, if you've been in a home for more than a few years, your home mortgage is probably going to be about 3 to 4%. And if you were to go out and get a new mortgage right now, it would be higher than that. Most places 5 to 6%. Does it make sense to put mortgage balance at 3% onto a HELOC that's 8%? It might not be a good decision. So it may not actually help in the very moment we're in right now to try to pay your house off with your HELOC. It might be better to keep making your payments on your HELOC and use the cash flow that you have to look at how to invest it well. And I always go back to this. Robert Kiyosaki's book, Rich Dad, Poor Dad, really outlines the difference between investing for just ownership of a thing, like a house even, or a stock or a bond. That is just an ownership play. But those things do not give you any kind of cash flow. They don't produce any monthly money or quarterly money. Stocks can give you a dividend, but they're not really going to pay the bills, right? It's a very small chunk of money usually. This is an opportunity with a HELOC to learn how to be a good real estate investor, to figure out what does a deal look like in your community. What would it look like to get a renter into a property that you own and have $200 to $300 a month coming in from that renter for doing very little work yourself? What would it look like to buy a business or start a business and have cash flow coming in from a passive income type of business? These are things that you can set up and things that you can get to because your HELOC has capital. It's money that you can spend towards a goal. Now, I totally realize there's some people out there that are like, no, we should never have a HELOC because you're just going to spend it. You're going to go buy something that you never would have bought, and you're going to just ruin your life. You're going to end up with more debt. And I get that. So if you have bad spending habits, that's the first thing you have to fix. But when it comes to using a HELOC as a powerful tool, if you understand how it works, you can then use it the way it's supposed to be used. And that brings me to this question. What is the true goal of being debt-free? And my answer to that question is to reduce your monthly expenses that go toward debt repayment, because that would involve an interest cost that flows away from you and towards the lender. So then you would want to free up maximum cash flow, and that extra cash flow still needs to be directed somewhere. So you need to understand how to invest it wisely. If you get to the point where you're debt free, you have money flowing in, what are you going to do? Just automatically retire because you don't have to work? Probably not. Are you going to quit a job you hate? Maybe. What would it do for you to be done with debt? Would it change your job? Would you do your job even if you didn't have debt, right? I think there's a lot of people that would say yes, they would. So what are you going to do with your extra cash flow? And I think the logical answer to that question is you got to find a way to invest it wisely. Because if it's just sitting around doing nothing, you're going to feel like you're wasting it, right? So I'm really passionate about this. I really want people to be able to pay off the stuff that is dragging them down, but then really look forward into the future on how to invest wisely. Don't just let this cash flow that you have go to waste. So, 3 ways to get started with velocity banking. You can download the free guide plus the HELOC checklist. You can check out my new course, which is how to get the right HELOC for velocity banking. I give you some really clear guidelines, about 2.5 hours of content with some extra bonuses, audio version included. And then you could also meet with me for individual coaching. I got a free 30 minutes discovery call. You follow the link and get on my schedule. So thanks for watching, and I really appreciate any questions or comments you might have, and look forward to meeting with you the next time. Thanks.